All right, let's get right into it. Today, we're going to pull back the curtain on a hidden force in the global economy, something that could be a ticking time bomb for your investments.
To really understand the risk here, we have to rewind the clock to one specific day that sent an absolute shockwave through the financial world, August 5th.
On that single day, Japan's Nikkei 225 stock index, well, it just fell off a cliff. A catastrophic 12% drop. Now, this wasn't just a bad day at the office. This was a historic, once-in-a-generation kind of event, and it left traders and investors all over the world completely stunned, asking one simple question: what on earth just happened? Okay, so to figure out what caused that insane crash, we first need to get our heads around the difference between a market's gentle tide and a destructive tsunami. And this quote just nails it. See, one process, repatriation, it's slow. It's predictable, kind of like the tide rolling in. But the other, the unwinding of this thing called the carry trade, that's a sudden, violent tsunami of selling that just wipes everything out. And that is exactly what we saw on August 5th. So what is this yen carry trade? What is this hidden engine that can cause a market tsunami? It's actually a pretty simple idea when you break it down. Imagine you could borrow money for almost free. That's basically what Japan offered for decades with its super low interest rates. So big investors would borrow massive amounts of Japanese yen and then turn around and invest that cash in higher yielding assets all over the world. The difference between the high return they made and the tiny interest they paid? Pure profit. And for years, it was a money printing machine. And we're not talking about a small niche strategy here. This river of cheap money flowing out of Japan was secretly feeling a massive boom in global markets, what some people call the everything bubble.
So just how big are we talking? Well, in 2024, Morgan Stanley put the number at $500 billion. That's a mind-boggling amount of borrowed money just sloshing around the system.
And get this, that might be the low estimate. The Bank for International Settlements suggests that when you factor in all the complex financial stuff like derivatives, the real number could actually be in the trillions. It's like this massive shadow funding mechanism for the world's markets. And where did all that cheap yen end up? You guessed it. It flowed directly into the assets that have seen the most explosive growth. You know, the very things that might be sitting in your portfolio right now. Big tech stocks, crypto, private equity, they were all being supercharged by these low-cost Japanese loans. So, here's the crucial part. We need to understand what happens when this giant engine suddenly slams into reverse, because that is exactly what happened during that flash crash in August. It's this absolutely vicious feedback loop. It all starts when the Bank of Japan hikes interest rates, even just a tiny bit. Suddenly, those cheap loans aren't so cheap anymore. Traders get margin calls, which forces them to sell their biggest winners, like tech stocks or Bitcoin, to get cash fast, to pay back those loans. They have to buy yen. But with everyone buying yen at the same time, the demand makes the yen stronger. And a stronger yen, that triggers even more margin calls. It's a self-reinforcing death spiral that can tear through markets in a matter of hours. So that flash crash, that was a warning shot, a preview of what could happen. And right now, the market is once again creeping towards what many analysts are calling the danger zone. They call it the death zone, and it's basically the tipping point. It's the moment the profit from the trade completely vanishes and the math just doesn't work anymore. And when that happens, everyone panics and rushes for the exit at the exact same time. And the consensus critical level, the magic number for that death zone, is a USD/JPY exchange rate of 140. If the US dollar starts buying fewer than 140 yen for a while, that's when the alarm bells really start to ring. And the data here is just undeniable. There's this powerful inverse relationship. Whenever the yen gets stronger, you see weakness in risk assets like the Nasdaq and crypto. This is not a coincidence, folks. It is the direct, tangible link between the Bank of Japan's policy and your portfolio, which of course leaves us with a critical, maybe even trillion-dollar question. The very same mechanism that inflated the everything bubble for a decade now poses a direct threat, and it's hiding in plain sight. We all enjoyed the party that was fueled by all this cheap money. The real question is, are we ready for what happens when the bill comes due?